All right, let's go over some 8-2 questions. It wasn't really clear when I said it. I made a comment about the typo of things on that one capacity variance question. It made me look back, and I did fix those questions in one version of the course, semester or a year ago. That very typo. That's why I noted it in my head and said something that wasn't very clear. But I guess I copied over the wrong test bank, an older version, to this class for that particular section. So it had the old questions that hadn't been fixed. If you have started an attempt since at the very latest last night, they should have a better the better and clearer articulation of those capacity variance questions. There are not a ton of those. So if you do see them, they should be up to snuff now. They should be better off. We'll see that. We'll go over those kind of questions, and we'll go over nope, that's not what I want. We'll go over the one constrained optimization question, which I hope to expand in a future term, but it's just the one question. And we'll also try to go over some more of those backflush questions, which is the majority of the test bank on 8-2. So let's actually start with that. Just make sure we get coverage. We'll hit the most important pieces first. All right, so here's a question. So a firm uses backflush costing and values inventory using throughput accounting. All actual amounts are equal to budgeted amounts. And I haven't done this in a while. How about I give you a minute or two and you work on this question and we see what you come up with. And I can't quite get it all on one page here. I think it's better to see the information than the answer choices at this point. So let's see if you can come up with what you think is the right answer here, or calculate out. Wow, this one really depends on the answer choices. So hold that thought for a second. Let's see if I can find one that is a little shorter, condensed, that we can put everything on one screen here. All right, how about this one? There we go. So this is a cost of goods sold after inventory costs have been backflush question. Let's give you a minute or two and see what answers we pick out of these four. All right. I'll put the Excel up over on the other screen out of your way and work on it over here. right, have we gotten any answers? Yeah. Okay. How did you calculate that one? Okay. Okay, I see where you're going for it. Good. Okay. So I like a lot of that process. The one problem I see with it is the throughput accounting word right here. So in throughput accounting, only the direct materials are considered a product cost. So put that in the numerator and repeat the process, and I think you'll get the same. You'll get the answer I got. I went a different direction. I went with COGS before, and then I did the backflush entry, how much we're backflushing out, and then subtracted that away from the COGS before amount. I like your process, though, of saying, well, cost of goods sold, in the end, after we backflushed out what we haven't sold, we're really just accounting for the cost of those units that we've sold. So that's one step, which is good. And then you multiply that by the rate of cost here. Just the cost, the rate is going to be different than what you had. So let's look on the wrong screen. Let's compare notes here. So the thing I did is I had cost of, I had only the direct materials cost be the product cost. They, in throughput accounting land, they ignore direct labor, and both throughput accounting and direct costing ignore fixed overhead costs. So in the numerator, it's going to be 15,000. In the denominator, it's at 5,000, exactly how you had. And we end up with $3 per unit instead of, you had $4 per unit as the cost. If you had the both DM and DL in the numerator, it would have been $4 per unit. And then you're multiplying it by, you did it the other way, but it went up the same answer. You said we have 5,000 total units. Take away the 100 in finished goods and the 500 in process. That means the units sold this period were 4,400. And if you multiply, moment of truth here, multiply the unit rate, that should be cost of goods sold after backflush. Because backflush is just accounting for that 100 and 200 we took out from the 5,000 right here. Sorry, 100 and 500 we took out from the 5,000 right here. Okay, but this should be the right answer with that one caveat. But good process, I like that. Did we get, yeah?
This question says it has no raw materials. If it said it did have raw materials, would you add it in?
You would, yes. So I included this right here, 0 backflush trip for the R portion, the raw materials portion. This is where you'd add it in if you were doing my way of here's the before COGS, here's how much we're backflushing, here's the after when you start the backflush. If you're doing it this way, let's see, the best way to probably do it is just to subtract it from this answer right here. So in this case, it's 0. But this would be the process you're doing. Calculate that, then subtract any raw materials that you have. Would be the idea. Okay. Yeah, so I just real quick how I did it. I know we're going to accumulate all the product costs in COGS. I calculate the rate, same way as we explained just a second ago. And I have these two amounts, number of units, times this rate. And I get 100 units in finished goods times that rate of $3 per unit. I get $300 as my backflush to finished goods. That rate of $3 times 500 units in process means I'm going to backflush for the IP portion of the RIP line in the entry, $1,500 to RIP to account for the 500 in process units. And I have 0 for the raw, but that's just because we have 0. That could be an amount in other questions. And so the sum of all three of those ends up being the total backflushed amount, the total of the debit sides of that journal entry, which means that the credit to COGS has to be that same amount to balance the journal entry. So I just took the before minus that backflush amount, and we end up with 13,200. Yeah, Corey.
Just click on the backflush to our portion.
Right here? I just typed in 0. Yep.
Is that ever going to be units or just
No, it'll amount of dollars. It'll be amount of dollars. Yeah. So if this question said, say there are $150, I would just put 150 in there. If the question like said no raw materials, it said $150 of raw materials in the period. That's what I would put. Yeah. Okay. In fact, if we wanted to do no math in this question, we really could just use that bolded phrase throughput accounting to rule out 3 of the 4 answers. Because throughput accounting means only DM is a product cost. So there's no way COGS is going to be greater than 15,000. That's after backflushing. How would you increase the cost after backflushing costs out of cost of goods sold? So we can rule out these 3. Just focus on this. It really is a question that looks mathy, but it actually kind of is just a definitional question. All right, so here's the refined version. We have this is how I refined it, because some really good feedback from a student about making sure that there was clarity in what it meant for the 20% downtime. I hope I've made that clear here. So all right, a firm has a machine that ideally can produce a unit every 5 minutes. So that word ideally is trying to put in mind that this is the most theoretical. It's that ideal of ideals. The theoretical capacity is going to be 1 unit every 5 minutes, which would be 12 units in an hour, and 12 times 24 gives us 288 units every day. That's the theoretical capacity for this machine. The machine supervisor calculates the machine needs 20% downtime for maintenance. And what that means is that every 5 minutes, so like we have 1 unit every 5 minutes is our ideal, every 5 minutes really it's going to produce 0.8 units. So we take that 0.8 times 12 5-minute increments per hour times 24, and we can get a different amount for our practical capacity. So that's theoretical capacity is the top definition. Once we've incorporated the idea of downtime, we have practical capacity. So it's a refinement of the theoretical model. Still theoretical though, still in the theory land instead of in the empirical land, which is the bottom 3. All right, so let's look at this. This is a, what is it, rate-based waste question. All right, so we have 0.8. Well, let's start with the 1. Theoretical capacity is 1 every 5 minutes. There are 12 5-minute increments per hour. That's 60 divided by 5. So for every hour, we're producing, this is units per hour. And then we have 24 hours in a day. Oof. So this is our theoretical capacity. And then if we repeat that, but now saying, no, I don't want to cut it. Copy it. But change the unit every 5 minutes to 0.8. We get a practical capacity of 230.4 units every day. All right, so it's questions asking what is the rate-based waste for this machine. Well, let's double check something here. Let's make sure we're not off our rockers. Let's go to the website, textbook, chapter 8. Go down to capacity, waste, capacity variances. Rate-based waste is theoretical less practical capacity. Those are the 2 that we can discern from this fact pattern, and rate-based waste is the difference between these 2. So we can take the difference between these 2. So that should be our rate-based waste, which is one of the answer choices. Yep.
If it was the same question, but ask for the management policy waste? Would you be able to do that?
We could not. We have one of the two, but we have no information about normal capacity. Or rather, if it's exactly the same up here and doesn't have an extra sentence that says, well, normally normally the machine produces this number per day or whatever, then we couldn't do the question. Yeah. That would be, you'd pick this one. It cannot be determined with this information. If one of you out there has this question, but it says, does say something about normally, then you have normal capacity, and you can take the practical capacity minus whatever normal capacity it gives you, it'd be like a sentence right after this parenthetical, something like that. And that would be your management policy waste. Okay? Isn't an enormous part of the test bank, but you'll get familiar with the questions enough to hopefully it meet its learning objective of being in here. All right. Some of the formatting really got spaced out on some of these questions. Interesting. We'll do one of these two questions. They seem to be very similar. Let's try this one. Okay. So a firm uses backflash costing to assign product cost inventory and values inventory using throughput accounting. All actual amounts are equal to variable budgeted amounts. Firm has no variable overhead. Okay, so that just makes it simpler. We're going to include fixed overhead at all? We can ignore that. We can ignore that all of Chapter 8. Always ignore fixed overhead in Chapter 8. Question is, do we include direct labor? Well, this bolded phrase here suggests we should not include direct labor. They don't consider, if you're using throughput accounting and the theory of constraints, you don't want to consider direct labor to be a product cost. What you're trying to do is tie your product costs as closely as possible to what is really going up and down as you're pushing additional throughput through the constraint of the business. And again, going back to it, many workers now are on a salary, and even if they're on a wage, hours don't match up directly with the volume going through the input, the hours that people are working. So there's a lot of noise, including the direct labor number, as an inventory cost would be their argument, at least. All right, we have our total complete and in process, 10,000 units. Ending raw materials, again, $0. If it were a different amount, we would need to include it, and I'll make sure I note when we need to include it. We have 35 units in finished goods and 25 units in process. Which journal entry appropriately backflashes cost inventory accounts? Well, let's see if we can rule some out. Looks like they're not indented, but they are labeled. So the debit would be further left, and the credit would be indented if you're using the more traditional method of how these are looking. So debiting cost of goods sold. No, let's not do A. That can't be the case. We're not going to increase cost of goods sold. Cost of goods sold is an expense account. It would increase with the debit. We're trying to backflash some stuff out of cost of goods sold. So not A and not D also as a result, right? So we're between B and C. And if I had to make a guess, just to increase my odds, maybe the professor, is testing me on whether I'm going to include that DL number. If I include direct labor as a product cost, it probably makes me backflash more to the unit. So if I had to guess I'm already at 50-50, but if I had to guess, I would say probably he wants me, he's going to tempt me to pick this one, but the real answer is B here. But let's just figure out at least one of those lines here. Let's try and figure out the RIP line. So 1,500, this is throughput counting, journal question. Journal. 1,500 direct materials cost. 10,000 units. It's total units. And that just gives us a nice, easy 15 cents cost per unit. Maybe we're creating little plastic pieces that are just going to go into some manufacturing process later. We're just some small time manufacturer here of this little tiny piece. 15 cents per unit. Okay, and we have the RIP. The debit to RIP here is going to debit to these 25 units in process for the IP portion, plus the $0 for the portion. So I'm just going to include the IP portion, since I said verbally that we don't have to worry about the $0. 25 units in process times 15 cents. So that is the RIP debit. So yeah, my guess was right. The professor was trying to hoodwink me into including direct labor as a product cost. Now, that's relevant because I know right now the only deadline you're worried about is 8-2, but in case you aren't connecting the dots here, on the exam, of course, you'll be tempted to apply a direct costing framework if you don't pick up on the idea, oh, this is actually a throughput accounting question, because they're all intermingled in the final. Okay? Yep.
I have a journal entry question where there's two answer choices that are exactly the same, except one of them, the RIP is separated into WIP and the raw materials, and the other one is combined into WIP.
Can I peek at it real quick? Is it right up there on your screen?
Yeah.
Because when you say exactly the same, do you mean that the raw materials and WIP together equal?
The balances will be the same.
Gotcha. Yeah. Pick the RIP one, rather. Yeah. Yeah. On these questions, let's RIP. Let me see, where do I introduce it here? All right, so many backflash systems combine these accounts into a RIP account for raw and in process. We're going to assume that this is they're using the traditional backflash system, so it's using the different definitions of inventory accounts. Yep. Yeah, no, go ahead and assume every time you see a Chapter 8 question that they're using the weird inventory accounts, RIP conversion costs, if it's using direct costing. Otherwise, there wouldn't be any conversion costs if it's not. And finished goods, use RIP. Okay. What other questions do we want to look over here on 8-2? Are you giving you trouble? Yeah. The waste ones? Sure. I don't know if I have any open answer questions for this exam. Yeah, I think this test bank is all multiple choice. All right, so here is this one. Look okay just to work on too. Okay, so this is doing the same thing. This is the same question as the above one, except it has an extra sentence, which is what I said it would have, right? And it's asking for exactly like you were asking, Tyler, management policy waste. All right, so this is the very question that I hinted at might be, it's not the one you had, but it might be a different version than the one you had. So firm has a machine that ideally can produce a unit every 5 minutes. We already know that means 288 units per day is its theoretical capacity. 1 unit per 5 minutes, 12 5-minute increments per hour, means 12 units per hour, times 25 4 hours in a day, gets us 288. Okay, and the practical capacity is that times 0.8, or using 0.8 per unit, 0.8 units per 5 minutes, gives us 230.4. So that would be our practical capacity. So that's our top, 288 to 30.4. That's what it means, right? And then this will be rate-based waste. We're asked management policy waste, which is the difference between 230.4 practical capacity and the normal capacity. So over the last few years, the firm has produced an average of 20 or 200 units per day. Okay, so that would be the normal capacity. Normal meaning this over the last few years is what makes it the normal. So smoothed out over time with different bumps, smoothing out the bumps that might happen. One day it has a lot of stuff, one day it doesn't do very well. The norm is going to be 200 units per day. So the difference between those two is 30.4. Is that okay? Sorry, I ran away from that question. This is management policy waste question. 200 is our normal capacity. And so I'm going to go down one. 230.4 minus 200 is our management policy waste. So the firm's going to ideally try to find out, well, why do we not reach our practical capacity? Is there any way we can decrease that waste to get normal capacity over time up closer to practical capacity? What management policies can we introduce to kind of do that over time? All right. What else do we want to see on ATH2? Did somebody else have a request earlier? That might have been you. You asked for more of these variance, capacity variance questions. I could figure somebody else asking me too. Yeah, go ahead. Yes. Okay, we need to get to that one. It's the one oddball. So we'll do it together, and then you'll know the answer to it, and that's all we can do. All right. Oh, we didn't get it. Let's try again. Yep, exactly. We need to. Here we go. So the corporation has 3 product lines with limited demand. The firm has no fixed costs. Below are some facts about the firm. So we have each column is a different product line. All right, I ran out of naming conventions, I think, at this point. So it's really dumb. Product has a monthly demand of 100 units. It takes 3 machine hours per unit to produce. And the price per unit we sell it at is $70. Variable cost per unit is $60. The no product line has demand of 120, takes 6 machine hours per unit to produce. We sell it for $75. It costs us variable cost of $72. We have no fixed cost, so it overall just costs us $62. Way product line, 140 units of demand, 8 machine hours per unit, $80 price, $60 variable cost. So hopefully your chapter 3 ears are tingling. We got price and variable cost. We could produce a contribution margin for each of these units, which we'll need to. The firm can only supply 1,780 hours of machine time per month between the 3 product lines. What is the firm's maximum monthly profit? So the idea here is, this fits into chapter 8 under the idea of throughput accounting, theory of constraints, is that we have a constraint. We have a limit as to how much machine time we can put in. So we want to get the biggest bang for our buck. That's the key heuristic we're going to use for this kind of problem. For this problem, sorry, I want to make it sound like there are more. No, this is the problem. So to get the biggest bang for our buck, we want the most profit. That's what it means. We're maximizing the profit for those 1,780 hours. So what we need to do is we need to take contribution margin of each product line and then figure out contribution margin per machine hour for the product. Because we only have so much machine hours to put in, so many machine hours to put in. So we want to prioritize the product lines first of all and fill all their monthly demand that are giving us the most contribution per machine hour that we're putting in. And then the second most. And then any leftovers, if there are any, to the third most. We're going to prioritize them based on this. I added an H just for kicks here. Ooh, maybe it will copy over. Let's see. Nice. Okay. So we have unit contribution margin, just taking the price minus the variable costs. So based on this prioritization, if we just stopped here, we should start with weigh, next do no, and then last of all, we would do O. If we just stopped at unit contribution margin, that seems to give us the biggest bang for our buck. First, we would start with weigh, then we would go with no, then with O. The problem is this line right here. They don't take the same amount of time on the machine. Specifically, weigh is very greedy on the machine. No is medium greedy on the machine. And O, wow, that's really quick on the machine. And the machine is the constraint. We can only have so many hours of machine time. So what we need to do is we need to take that unit contribution margin and say, what is contribution margin per machine hour? $3.33 per machine hour, $2.17 per machine hour, and $2.50 per machine hour. Now we have a new ranking. This gives us the most bang. This is contribution margin per unit of constraint. Oh, kept the wrapping good. We're getting the most dollars per machine hour when we put them into the O product. So we want to fill that demand first. So we will. All 100 units times 3. So that's machine hours spent. And that means we earn $1,000 from that. Does that make sense? Our monthly demand is 100. We fill out monthly demand. We earn $10 contribution margin per unit we sell, full 100 units. We end up with 1,000. So that is our CM and profit because we have no fixed costs. That's what the problem says. Great. Okay, now we can move on. Let's start up here. Let's put in 1780 is the constraint. So the next one we should do for the biggest bang for the buck is weigh. After $3.33, the next biggest is $2.30. So let's try and fill that demand. Uses up a lot of machine hours. We still haven't used up all of them though. We spent 300 on O. We've spent 1120 now on weigh. We've used 1,420. If we sell 140 of them, we earn $20 per unit. We've earned $2,800 of profit. And last of all, we can't spend more machine hours than we have. So if we, let's make sure first of all, could we fill the demand? No, that's too many machine hours. That's over the 1780. That sum of 2140, that's over the 1780. So what we need to do is we need to just take the remainder after we've used the 300 and the 1120, and that's what we're going to, we can only spend the last 360 machine hours. Now they equal 1780. And so we can only sell that many, we can only produce that many of the no product. So we take that, 360 machine hours means 60 units times $13 of contribution per unit. So we're earning $780 from that. So add together our, I didn't like that. Oh. There we go. And I wonder if I can get away with that too. Okay, good. Just as a check figure here, making sure I didn't overuse machine hours. Total machine hours spent, 1780, which matches the constraint. We earned 4580 as our maximum profit there. Okay. All right, so I really like this area. I don't include it enough there's so much opportunity cost to include more time on this chapter 8 section. So I wish I could include more of it, specifically the theory of constraint stuff. I'll tell one story real quick. When I was an undergraduate student, I transferred over to a new university and had some transfer credits, but I was trying to figure out how quickly I could get through this degree. Yes. E70. I'm doing the monthly demand times the unit contribution margin. Is that working now? Okay, good. Oh yeah, so we just I don't know if this is needs to be said, but just if you're curious, we need these numbers to prioritize the products, but we really aren't using them to calculate contribution margin directly. Yeah. Huh? Yeah. If you calculated how many machine hours you're using and then multiply it by that, yes. Okay. Well, good. Hey, good. Yeah, you could take this 300 times the 3.33 and get it. Perfect. Yeah. Okay. So, story time. Back to my favorite. That's a silly, dumb joke. But regardless, the point is, I'm an undergraduate student, and I'm trying to get through my undergraduate degree as quickly as possible because I was at Arizona State University, and the president there at the time, still there, Michael Crow, declared that he was going to make the Arizona State University be the new American university, which is great branding. That's just, I'm sure he spent a lot of time with the marketing team coming up with that one. What does that mean, be the new American university? It means charge a high tuition. That's what it means ultimately. So every semester, tuition was being raised 5, 10, 15%. Was going up like crazy. So if I want to minimize the amount of cost, I had to keep as short as possible and as early as possible my career there. So I said, okay, well, what is the minimum time I could get through this degree? So I'm like a company, and I'm producing degrees. And unlike this situation, this problem is holding constant time and saying, how can you maximize the number of units? And I'm saying, well, I want one degree. No, I don't want that many degrees. I just want one degree at this point. I'm holding that constant. How can I minimize the time? So I have the best time per degree situation. And so I go through and I look at, importantly, my constraints. And I say, all right, well, I'm trying to get an accounting degree. What are the constraints here? What are the requirements for an accounting degree? I have a certain amount of credit hours I brought over, so that can help offset the 120 credit hours required. Time-wise, there are these things called prerequisites. So certain classes have to precede other classes, and some of them form big, long chains. So I said, what's the longest chain? And this is a term in theory of constraints called CCR, critically constrained resource, something like that. And that's basically what I was figuring out, was what is the critical chain. That's critical chain. What is the critical chain here that I have to complete in order that thereby determines the minimum amount of time I could spend? And it was a 6-class chain. So I said, okay, well, if I get every class that I want in spring and then summer and then fall, I could do this in 2 years and fit everything else in accordingly. So as a decision, and it worked out. I mean, there were other factors to consider. Once I decided this is the minimum I could do, I have enough credit hours that, yes, I could get that number of credit hours added from Arizona State now to reach the 120 in that time frame. So then it became managing the main constraint and making sure that if I'm going to invest extra time in a class to make sure I don't have to repeat it or something, I'm going to pick that time on the critical classes. Because I could, let's say, for example, I got a grade I didn't like and I wanted to repeat a class and it's not a critical chain class, I could still do that and finish in 2 years. If it's a critical chain class, I have now made that chain into 7 classes long. Okay, well, now I've literally added an extra semester. I've added an extra term with rising tuition. That can be costly. All right. that's as far as I'm going to go into theory of constraints for you. I like it as a decision framework as part of your toolkit at the very least in decision making. What is the constraint? What are the constraints? Excuse me, and which of them is the most limiting constraint, the real bottleneck to the situation? Sometimes it can help you look at situation in your personal life, in your professional life, in business, a little differently. This is the one question like this, by the way. It used to be in chapter 3. I wanted to bring it up then, but really, there's a lot going on in chapter 3. Lots of equations already. And why bring up theory of constraint stuff then and say, well, hold on for like the rest of the semester till chapter 8, and then we'll talk about it some more. Just put it here. And over time, maybe its seed will grow and we'll have a whole section of questions like this. We'll go over them more in future semesters. But I won't see any of you then. You're all, I won't see you. You'll continue on and flourish. All right, let's talk about chapter 10 if we're okay with chapter or 8-2. One more, and you want to see something? Okay, well let's stay with 8-2. What do you want?
It's the one that's
No
no flush.
flush.
I saw it on the.
Is it all one word?
Yeah, I think so. I don't know. It was on the last quiz we did.
Okay. Well, I'll have to just get a new attempt, unfortunately. Okay. I'll try both. Nope, neither one.
I think it was terrible.
Well, I'm going to need to start looking at the questions.
Or that one.
Oh man,
Anyone that we haven't seen.
what am I doing? Diuretic. Yeah, this one okay then? Okay. Are you sure it's the question stem works okay? It's at a before and after cogs questions that.
I don't know what the no flush was, but like this, we haven't seen this one. So.
Okay, you want to see? No? Okay, fine. All right. And Garrett, did you? Not this one. Okay, different one. We'll get to you. Raise your hand again if I forget after this. All right. So Diuretic is a firm that produces portable sanitation. I was on one this time. This firm uses backflush costing and values inventory using throughput accounting. All actual amounts are equal to budgeted amounts. The firm has no variable overhead. All right, so the debate is, do I include direct labor or not? Do I include direct labor? No, we don't include direct labor because this bolded phrase right here. If it said direct costing, we would include direct labor. We would indeed include direct labor. But it doesn't say direct costing. This is throughput accounting. So we're only going to consider this as the numerator when we're deciding, when we're calculating how much cost goes out. How much cost gets backflushed to inventory accounts. That's what I'm saying. All right, we have total and completed total units completed in process, 1,800. The units in finished goods, 20. Units in process, 10. And also we have $20 of raw materials in the period. All right. So which of the following are the correct balances for the COGS account before and after inventory costs are backflushed? It looks like I was wrong. The debate is not about direct labor. The debate is, do we include everything? Because look at these four numbers. It's either 9,000, which is A and D, or 31,500, which is B and C. I think I only get 31,500 if I add in all three of these together. 9,000, 4,500, and 18,000. But we don't do that, right? We would never include fixed overhead in any of the Chapter 8 questions because they're all either direct costing or throughput accounting questions. That's a more lean mindset. And because it says throughput accounting, we've not included this. So we can rule out these two right here. The before is going to be that 9,000. Okay? As direct material costs, which are the only product costs, are incurred, we're going to be debiting them to cost of goods sold. So if we incurred to 9,000 direct materials cost, the cost of goods sold balance before we backflush is $9,000. The question is, do we backflush $150 so that the after is $88.50, or do we backflush $170 so the after is $88.30? $20 difference. Oh, very suspicious. Very suspicious. Maybe he's testing us on this. This is diuretic. 9,000 is COGS before. We have also 9,000 is DM cost. That's what that comes from. 1,800. Oh, 1,800 units, total units. So we have, division. 9,000 divided by 1,800 gives us $5 cost per unit. Okay, we have 20 finished goods, 10 in process, $5 rate times 20. This is our debit to finished goods for the 20 finished goods units. Copy that down. This is the IP portion of the debit to RIP. $5 per unit times the 10 units in process. And then we also have to add in the $20, the portion of RIP, of the debit to RIP. The sum of these three, here I'll add an extra space here to help. The sum of these three is our total debits being backflushed away, which means that we must be also crediting COGS that same amount. This is total backflush, debits, which means the credit to COGS is also that same amount. So that'll be COGS after backflush. And yep, sure enough, if we had forgotten to include the $20, the portion of RIP, we would have $150, and it would be, we'd come up with this number right here and click the wrong one. Okay? Any cells you want to see? Okay, what do you want? So it like says, oh, kind of like this one? Okay, this one does work for you? All right. So this one right here says, if you search the RIP account in the firm's cost accounting records on January 15th, what balance would that account show? All right, so a firm uses backflush costing to assign products cost to inventory, and the firm values inventory using throughput accounting. At the beginning of January, the RIP account has a balance of $0. On January 10th, the firm purchases 1,000 pounds of raw materials worth $10,000. At the end of the month, 10 pounds of raw materials worth $100 remain unused. 50 units were in process, $6 material cost per unit. So during the month, as we are incurring these product costs, the product cost of this $10,000 here, that's going to be debited to cost of goods sold. We are accumulating all of our inventory costs during the month in cost of goods sold, and then we are going to backflush them at the end of the month. So RIP has kept at the $0 balance. That's the end of this question. Other questions will say, if you check the records on January 15th and like February 15th or something like that. So 0 is right for January 15th. If it says a date after January 31st, so February 1st, 2nd, 3rd, wherever, then we would have to figure out that $10,000 in, we have to figure out the amount debited to the RIP account when we backflush. 50 units in process times $6 per unit gives us $300 being debited for the IP portion of the RIP entry, plus $100 here would give us $700. I would say the RIP account after January 31st would be $700. That makes sense to me. Yeah. I didn't trick you quite well enough on this question. I'll make a note for that for next semester. I'll say Brenna wanted me to include this extra special trick question for you. Yeah, Garrett. Yes. It doesn't have to be 0, just whatever the starting balance is. It hasn't changed. Yep. Yeah. Okay. Yeah. We go back to 8-1 stuff. Okay. Yeah. We can. I can do. How about like a question? Is that all right? So let's pick this one. Make sure we got it right. I think it's worthwhile simply from. Oh, that's what am I doing? Simply from the fact of come final time, you'll have to be able to compare the two. And so I'll bring it up in this context, it's fine. Let's do an 8-1 question, direct costing with a conversion cost, like a journal entry question, or like, okay. Yeah. So here's one I think would work. That makes sense. All right. So we're just put a note in your mind. This question we're talking about back to 8-1 stuff, contrasting direct costing to what we've been going over in 8-2, which is throughput accounting. So we're asking what journal entry appropriately backflushes to inventory accounts. We can rule out the two, the debit to COGS. So it's not A and it's not D. It's a question of, is it C or B, or D? I don't know why Canvas is against naming or numbering these answer choices, but it would be B and it would be C if you were to letter them. Okay, so we already have per unit rates. So luckily, we don't have to divide anything by this 15,000. We already have that set up for us. It's a question of which ones we include. And I highlighted the ones we include. For direct costing, we're going to include these as product costs: direct materials, direct labor, and variable overhead. We ignore fixed overhead, like always in Chapter 8. Now, the amount being debited to conversion costs specifically, which is one of the objectives of this question we're going over, is either $612.50 or $750. Conversion costs are labor and overhead, and only variable overhead count in direct costing. So $2.45 is our conversion cost per unit in this case. I'll put that, where am I going? That. All right, 1.5 and oh, sorry. Yeah, we'll copy it all down. That's fine. DM per unit, DL per unit, and VOH per unit. So the conversion cost per unit is $2.45. And we have in process 250 units. So we're going to multiply the conversion costs times that and get the amount we're debiting to conversion costs. So conversion cost is just the portion of work in process that is due to direct labor and variable overhead. It's an inventory account. We're rearranging the inventory accounts to make it more useful for a lean accounting setting. So conversion cost is now the portion that's conversion costs that are in work in process. The RIP portion, RIP of course includes a raw part, direct materials, which is this $50, and it includes a portion of these units in process. So the portion is just that $50 copied over from the question. And the IP portion of the RIP debit is materials times that 250 units in process. So 375. So we've double confirmed that, So that is the debit to RIP. So now we've double confirmed that this one looks right. Both its conversion cost debit and its RIP debit look right here. And finished goods, debit finished goods. Oh, we didn't copy that down. 500 units in finished goods is that 500 units times all the costs that are product costs because they're finished, 1975 right here. So triple confirm that this is the right answer. Okay? Is that all right? Perfect. All right, so let's take a look at the last chapter of the semester. Responsibility accounting. And yep, I made fun of Ready Player One. Don't at me. These are my pictures. I was walking through Walmart one day, which I do. I'm not too cool for Walmart. And it says that apparently the only price they could move Ready Player Ones was at $0. So
Did you not like it? Or is it just a stand?
it was just a stand. I mean, I wasn't a super fan of it. I agree with the critiques of the story problems it has or whatever. But it just happened to be the one that had that stand up. And in honesty, they just hadn't set it up yet. But it doesn't stop me from taking a low blow. All right, but the point is that when something fails to meet expectation, which on a box office level, Ready Player One did not quite meet its expectations, we question who is responsible. Who? All right, so 10-1, which is next week's topic, covers service departments. The longer name is Service Department Cost Allocations. I think the module just says Service Departments. That's 10-1. And then 10-2 covers transfer prices and ROI/residual income. So there are three styles of questions in the Chapter 10 test pool, one style of question which is about service department cost allocations, and one of which is about transfer prices, and the third is about ROI/residual income. These they all fit into the question of decentralized decision rights and responsibility accounting, because we're trying to move costs around the firm to get it to the responsible party for the decision that's been made. All of these things, all three of these have to do with that. So, the story of a firm is that over time it grows, if it's a good idea, an idea that has a place in the market, people value, customers value, and eventually it gets big enough that it has to decentralize more and more of its decision rights. Means get those decision rights out to the people who are at the zone, at where the information resides, the zone of information. So here's the idea. Let's say I'm a hot dog vendor. I got my little cart. I push it around myself. I sell hot dogs. Okay? I'm pretty good at it. I sell hot dogs. They're very nice hot dogs. I take care of them. I am directly talking to the suppliers. I buy them for just only the most reputable hot dog vendors. Hot dogs themselves, I don't know, reputable and hot dog doesn't go in the same sentence. But regardless, as far as hot dogs go, they're very reputable. And I get the right condiments. I got a good variety of condiments. I got the ones people like because I'm talking to customers every day. And so, hey, so-and-so said they really want this Dijon mustard. So I'll make sure I have a Dijon mustard. So I am a locus of information. I talk to the suppliers. I see the customers. I make the hot dogs. I'm informed on all parts of the process of this business. I'm very successful, so much so that I open a restaurant, a hot dog restaurant. So now I am the owner of a restaurant. So I'm going to have to employ people because it's going to put a lot more people through the restaurant. I can't serve every single one of them. I can't go buy every single batch of hot dogs from the hot dog vendors. I can't go decide every single amount of condiment and which ones we carry, which ones are in demand, I should say, from the customers, to use the prior example. So my information level as the owner, because I now have a restaurant, has diminished. I am now further removed from the information about how the business is running. Supplies, the process of cooking the hot dogs, the customer reaction. A lot of times you will be at a restaurant, especially if it's a finer restaurant, and the manager or the owner, manager usually, will come around and talk to you or whatever, try to be real nice. And there are two components to that. One is to make you like the restaurant better and feel more like it's a personal connection. And the other is for the manager himself or herself to get direct information from the customers and see what's going well, what's not going well. And this is the inevitable reason why there's drama every time there's an Undercover Boss episode. The Undercover Boss is a franchise that is in like 80 different countries, because it's inherent in the structure of a business that there will be an information asymmetry between the top echelons of the company and the front line where the money is actually being made. So anytime you go down there, anytime the top echelon goes to the front lines, you've got a mismatch of skill sets. So you've got a CEO who can't use a wrench or whatever the situation is, which is funny to people. You have a CEO who's surprised, oh, this is what's actually happening in my company. And you often have also a socioeconomic disparity, because the CEO likely has a lot of money, probably wants to give some of that money away to people who are in need. And that creates good TV, is what they decided. But core to it is the decentralization of information, which means you need decentralized decision rights. You want the decision rights to follow the information. Do you want people making decisions who are uninformed? Just generally as a rule? No, I don't think so. Do you want me making like a medical decision for you? Oh no, he'll be fine with that. Yeah, give him that drug. No, please don't. Don't put that on me. I am not well enough informed to make that decision for you. You would like to make the decision because you find yourself to be maximally informed. And if you're not, you probably would, hire a doctor to help you be informed. That's kind of the idea. And so as the firm gets larger and larger, let's go back to the hot dog idea. Now, my one hot dog restaurant was so successful that now I have a chain of hot dog restaurants. I am even further away from questions about how is this line of hot dogs working well? How do customers react to it, I should say. So the decision rights need to follow the decision, the information. And you need to decentralize it because the information is spread throughout the firm. And I'm going to lie, there's like a sentence or two that helps logically connect this. And so in the example of the restaurants, for example, it's going to be more the frontline workers in a well-run restaurant who can make the decisions of, you know what, actually the hot dog that wasn't cooked very well, we'll take it back and give you a refund or give you a new hot dog. You don't want to have to run that up the chain to the owner. Well, table 7 says the hot dog wasn't cooked very well. The owner doesn't know anything about that right now. They don't know how it was cooked. They don't know if this person's a routine complainer. They don't know how any of it. No. You have to decentralize that decision, right, about whether to give a refund, like right there, it's mentioned, to people who are actually informed about the situation. All right. So responsibility accounting is attempting to tie responsibility for the decisions as those decisions move around the firm, because they have to be decentralized. The decision rights are going to move around. So we're going to define responsibility centers. And there are 3 definitions here, and there's a 4th one we'll add later. So what decision rights you have could be cost decision rights, revenue decision rights, or profit decision rights, which of course is revenue minus cost. So the idea is if you are a manager over a department that primarily produces costs for the firm, you're a cost center. You're a cost center manager. You have cost center decision rights. So an accounting department, a legal department, IT, maintenance department, these are good examples of service departments that are cost centers. Service departments and cost centers are in some ways synonymous. They overlap a lot. So when we're talking about service departments, we're talking about a lot about cost centers. An accounting department is great. I worked in accounting departments. I train people who work in accounting departments or to audit those accounting departments. But we are cost centers. Nobody buys from the firm because they're like, oh yeah, I heard you had a great accounting department over there at Kellogg's, so I'm going to buy your cereal. No, doesn't happen. So we add costs. Whereas if you're in the selling business, you're part of the sales team. Generally, that's the best example. A sales team or like some frontline store worker or manager over them, you have revenue center decision rights. And if you're the manager over both cost decisions and revenue decisions, then you are a manager over profit center. Your profit center decision rights. You can make decisions about both of those. All right, that's how it's defined right here. So like profit manager is over both costs and revenue, such as a factory manager, branch manager, or regional manager. And the idea is your decisions at that level will affect either cost or revenue or both, meaning you affect profit. And it's key that, look, there's materiality questions here. Sometimes a cost center manager might control some small revenue stream, and a revenue manager might control some small cost related to the sales team. That doesn't make you into the other type of manager. Those are relatively small decision rights you're talking about. So yeah, I mean, the sales manager probably does affect the amount of costs for like printing paper for flyers and whatever, sure. But that doesn't turn him or her into a cost center manager or a profit center manager. That's a relatively small piece of what he or she does. So we'll keep that as revenue center definition. All right, so let's talk about focusing on service departments. The fundamental premise of service department cost allocation, the fundamental question is interdependency. The idea that service departments serve each other. The basic illustration here, let's go down to the illustration. All right. Ignore the fact that it's going to change around or whatever. It doesn't matter right now. The basic idea here is, let's say we have 3 service departments. We have 3 production departments as well. Production departments are actually producing the products that earn us money. But they use services from the service departments. So, I don't know, accounting and legal, IT, power and maintenance, just to lump a bunch of services into different departments. If each service department only serves production departments, it's actually a pretty easy question. You just figure out how much each production department used of the services of these service departments, and then you allocate those costs to the production departments. The idea here is ultimately is that you're trying to get responsibility to the people who decided the cost should be incurred. And if production department A requires a lot of maintenance, then we should be charging production department A for a lot of that work that came from the maintenance department. Keep that person responsible. Don't let that person, who's the production department manager, say, well, yeah, you know what? I'm just going to outsource all my costs to this other entity, and I'll be very profitable then. I think that literally is one of the problems they had at Enron on a different scale, but the idea was to isolate costs in different entities and play the shell game. Internal to the company, we could do that similar thing if we don't properly allocate costs between service departments. Okay, interdependency are all the arrows we see between service departments. Because the accounting department doesn't just serve the production departments. I said this was like accounting and legal. It doesn't just serve production departments. Also, it serves IT. IT has some accounting needs, and maintenance has some accounting needs, so they serve each other. And guess what? IT services the accounting software, and the computers used in the accounting department. And so we have 3 different methods of dealing with interdependency. And I'll just go over very, very briefly the idea here. All right, well, first of all, here is interdependency expressed in terms of a table. This table will be either your friend or your mortal enemy, because it's going to be like everywhere, every single question. This very kind of table. So we have a service department 1, a service department 2. They incur a certain amount of costs, and they do service to the other departments as follows. They don't do service to themselves. That doesn't count. 20% of their work is to service department 2. So that's an interdependency. That's a service department serving a service department. 35% of its work is to production department A, and 45% of its work is to production department B. Service department 2, $500,000 of costs, serves the other service department. 35% of its work is there. 60% of its work is to production department A, 5% to production department B. The 3 methods of dealing with this are the direct method, which says, let's ignore the interdependency. Let's act like it's 0. We'll go over on Tuesday how to do that. The step-down method, which says, well, let's just kind of do it in a turn base. So the first service department that serves the other service departments most, you get to allocate your costs to every downstep service department and production departments. And then we'll go to the next one, and you can allocate your cost to every downstep service department and production departments. And then finally we get to the last service department, which always is only allocating to production departments. The one rule with step down is water doesn't run uphill. You can't allocate to an upstep department. And the third way of figuring this out is use the reciprocal method, which is to mathematically solve exactly how much the interdependency, how much it affects the costs. So we have an algebraic solution here. 10-1 asks you direct costing questions. You have to solve them. Asks you step-down costing questions. You have to solve them. Asks you a few conceptual questions about reciprocal. I don't make you solve reciprocal questions. I want you to learn about it, and I'll go over examples of it, but you don't have to solve them. Okay, so Tuesday we'll talk about, specifically we'll go through direct costing. The direct method for service department cost allocations, and the step-down method.